about the textbook that you co-authored with Professor Charles Lee from Stanford University? Alphanomics, right?
Sure. So Alphanomics is a textbook based on a broader literature, including my own research, that can be viewed as an attempt to reconcile the practice of active investing, which is so commonly pursued among Wall Street professionals, with the theory of efficient markets, which are so commonly taught in MBA classrooms around the world. So Alphanomics really reflects two separate terms. The alpha portion of Alphanomics refers to the abnormal profits or excess returns above risk compensation that engenders or helps motivate arbitrage as an industry. The economics could be thought of as the costs and benefits underlying active investing that make it as sustainable as a business enterprise. And so in many ways, Alphanomics could be viewed as the recognition of the idea that in a world with costs and risk underlying arbitrage, the prices cannot reflect all fundamental information. Instead, prices respond to fundamental information, but also reflect things like fashions and fads, as well as innuendo disguised as information. As a result, oftentimes prices deviate from fundamental value. And Alphanomics helps identify or calls for people to identify sources of mispricing, as well as the need to protect oneself from risks and costs underlying arbitrage. And so what we try to teach in Alphanomics is a way for thinking about the world of active investing and the practice of active investing, what people should be aware of in terms of thinking about fundamental value, as well as how to mitigate risks associated with the practice.
Well, that sounds quite complicated, like a finance textbook rather than an accounting one. So what is the general implication for finance and accounting students then?
Sure, it's a great question. The implication is simply that in a world in which prices can decouple from fundamental value, we need ways or techniques for identifying cases where prices deviate from fundamental value. And so part of what we can do as researchers in finance and accounting is to identify low-cost techniques for understanding the nature of mispricing, to realize when value is quite different from price, for figuring out cases where prices are artificially too high or too low because of discretion in the financial reporting process that allows managers to misrepresent truth about companies. It's also the case that through careful analysis, things like fundamental analysis or valuation, we can find ways to identify and better estimate fundamental values of companies and ultimately help improve the apparatus of arbitrage through more sophisticated techniques and application.
Okay, so talking about technologies again, I mean, recently China is establishing a new board which is called Science and Technology Innovation Board, which is going to be in the Shanghai Stock Exchange. It's a new board of listing stocks which benchmarks itself with NASDAQ in the U.S. So I know you are a member of the listing council of NASDAQ. So as a member of the listing council of NASDAQ and also as a scholar, what is your view of this board, or what is your suggestion to this board?
It's a great question. It's tricky to figure out what I would recommend. I think part of what I have come to view over the years is that a listing on a stock exchange is more than simply a venue for trading. Stock exchanges now offer a variety of goods and services to companies that move beyond simply a host for trading their stock. So companies will provide, or the stock exchanges will provide, governance. They'll also provide marketing support. And so there are many facets to an exchange that make listing on an exchange useful. It's also the case that, like many other sort of network effects, it matters whether there are other companies that are sort of listed on that same exchange. And so there are peer effects from being associated with a technology, a technology index. So companies like listing on NASDAQ, I believe in part because there are many other, it's known for its technology, and there are many other sort of star corporations that exist on that same exchange. And so I think attracting some of sort of the initial leaders in the field, I think is going to be important for attracting others. It's also thinking about the products and services that they offer beyond simply listing, things like risk management, marketing, I think, governance. Those are a big part of what I think makes a stock exchange useful.
So if we know that there are a lot of Chinese high-tech companies that are currently listed in the U.S. Probably some of them, actually most of them should be in NASDAQ. So what do you think that the new board, the Science and Technology Innovation Board in Shanghai Stock Exchange, will be a competitor to the NASDAQ, or will they, be complements to each other?
Well, it's a great question. It's hard for me to forecast. I think that it depends on, my guess is it depends on where capital flows are. I think a big reason why Chinese companies end up listing on U.S. stock exchanges because they want access to the U.S. capital markets and U.S. investors. And so some of this matters from a regulatory perspective in the sense that if there are limits on U.S. capital flows moving overseas, or if there's some source of information asymmetry or risk that prevents investors from investing in Chinese markets, that could also pose a problem that limits the ability or desirability of companies to list on their home market. And so it's not only a matter of what the stock exchange can do, it's a matter of what the government policy and procedures are in place that encourage companies to list on domestic markets. Alphanomics critically relies on concepts from both finance and accounting. So what Alphanomics does is it challenges students to think about the arbitrage process, to find ways to develop lower cost techniques of engaging in arbitrage to identify mispricing. And so for a young researcher or a student who wants to engage in Alphanomics, there are lots of ways that you can contribute to the arbitrage process. For example, something as simple as developing new techniques for valuing companies. It would be quite useful in identifying mispricing, because the more that we can better estimate fundamental value, the better opportunities we'll have to understand or recognize when prices deviate from fundamental value. Another is to figure out signals that exist that investors do not yet seem to incorporate into price. Oftentimes they're low saliency signals that tell us about fundamental value, but it's simply that they are sort of flying under the radar of the average investor in terms of valuation. And so the more that we can sort of uncover the sort of latent signals that exist within the financial reporting process, the better that we can correct mispricing. And so oftentimes the financial reporting process engenders a lot of discretion. And what we know through large sample evidence is that managers will often use discretion to their advantage. They'll use their opportunity to say or present things in a favorable light to prop up the stock price, or perhaps to achieve some compensation requirement. And so the better we understand the discretion in the financial reporting process, the better able we are to reverse engineer the truth. And so the more that we know how managers are going to try to use discretion to their advantage, the more that we can reverse engineer truth-revealing signals and use that to their advantage. And so part of the research that I presented to students today was on the discretion that companies use in the timing of their earnings announcements. And the intuition that I gave to students is that companies are afforded a lot of discretion in when they announce earnings. They're typically afforded between 30 and 60 days to announce their financial performance. But there's a lot of discretion within that time frame in terms of when they announce. So some of the research I proposed to them today was a good example of what I believe Alphanomics can contribute. It illustrated that companies follow a very simple pattern. When they have good news, well, they rush out to share it. They want to be the bearer of good news. And so when you see companies announcing earnings early, it's typically a good signal not only about their profitability, but their valuations. At the same time, companies often want to use discretion to delay the release of negative news. And so they'll push back the timing of earnings announcements containing bad news. And so that's an example where we see that there's discretion in the financial reporting process. We know that there is an incentive for companies to try to manage their reputations, or for managers to want to present themselves in a good light. So if a manager wants to garner attention for good news, they're going to rush out and share it, such that no one else sort of preempts their good news. They want positive information associated with their name. But at the same time, if they have bad news, typically what you see is a company will push back their earnings announcement in hopes that the information sort of leaks out ahead of time, that we can blame it on other sort of trends or people within the industry that allows me to sort of move away from some of the blame. And so that's an example where once we understand the discretion in the financial reporting process, which is something that I think any sort of student of accounting or finance can, if they really stop to think about it, can figure out where are the sort of the latent signals? What are managers doing to make themselves look better? And once we understand that discretion, not only can we sort of reverse engineer the truth, we can use that as an opportunity to incorporate information into prices in a more efficient fashion and ultimately take away some of the incentive for firms to engage in that bad behavior in the first place. Further, I think we're really in an exciting time for accountants in that certainly big data is playing a big role in the sense that we have more and more information about the way in which companies are operating. We have bigger and bigger data sets that tell us about the nature of financial reporting. And the more granular data that we have available to us, the better able we are to recognize discretion, to get better estimates of firm value, to understand the sources and nature of risks, all of which are useful for active investors who want to generate higher returns with lower risk. And so alphanomics is really a call not to accept that prices are efficient or that they necessarily reflect all fundamental information, but rather through insights and hard work that we can identify information that's not yet reflected in price, and in doing so, contribute to more efficient markets.